Hello, my name is Brad Medlock, and I'm a group leader in the Upper Midwest Regional Field Office in Des Moines, Iowa. In this presentation, I'll be talking about section of ARMS 3 questionnaire, which covers operating and capital expenditures. This video will cover the highlights of this section, but it's also important to review the interviewer's manual and any other training materials provided to you. For this presentation, it may be helpful to have a copy of the version 1 questionnaire open. Data gathered in this section are used to estimate producers' cost of doing business. These estimates are critical indicators to the health of the farm economy. They also provide a basis to track cost over time, which provide useful insight into issues faced by those in the farm community. Estimates from this section are included in the Farm Production Expenditures Report published by NASS around the end of July each year. This publication also gives the first indication of how you can break out information by farm characteristics, in this case by size and type of farms. This ability is one of the most important things that ARMS allows us to do beyond simply reporting the results by item. Information from this section are also used to provide annual weights for NASS's computation of prices paid indexes, a component of the calculation of parity prices required by the Agricultural Adjustment Act of 1933. The prices paid indexes are also used in the calculation of depreciation and in forecasting of expenses. The data are also used by the Bureau of Economic Analysis to prepare national estimates of gross domestic product and by the USDA Office of the Chief Economist, whose Office of Energy Policy and New Uses pay close attention to the volume of cost of fuels by type on farms and ranches. ARMS is intended to provide an economic overview of the family farm. Up to this point, the form has focused on types of revenue or income received or expected by the operation during the calendar year. Data gathered in this section are used to estimate expenses, which represent producers' cost of doing business. These estimates are critical indicators to the state of the farm economy. They also provide a basis to track cost over time, which provide useful insight into issues faced by those in the farm community. Most of the questions in this section will focus on items spent by producers and partners. When collecting data in this section, be sure to report only expenses for the targeted operation. That is, the operation defined by the total acres recorded in Section A, Item 4. This section has a lot of detail and include-exclude instructions. These are important, but do not get bogged down by them. Do your best to find place to record it and leave comments if unsure or for unique situations. Specific expenses paid by landlords are asked at the end of the section. Contractor expenses are calculated behind the scenes, but are based on data collected on a separate survey of just contractors. Finally, if the respondent can't give the exact figure, get the best estimate or percentage used and make a note. Section is separated into 3 parts. Question 1 through 34 of this version focus on operating expenses, which include expenses related directly to day-to-day operation of the farm business, such as those shown in this slide. Operating expenses typically include the sum of the cost of goods and services, which include the cost of labor, inputs, and materials used, as well as the portions of overhead related to production, combined with costs associated with selling agricultural products, general and administrative expenses, and depreciation expenses. Household and personal expenses are not included here, even though for some operations, all farm income is used to pay for on-farm expenses. We also want to exclude expenses associated with performing custom work for other operations if a separate set of books are used for those custom businesses, and expenses paid by the producer acting as a landlord or land rented to others. Why are we collecting these farm expenditures in such great detail? Well, this ensures that no data will be omitted, particular items not typically found in records books. We know that if we do not ask for cost by item, respondents will fail to report some expenses, and leaving out some costs would make net income appear larger than it should be. Also, detailed expenditures allow USDA to compare and quantify item by item cost per unit indicators. Examining expenditures this closely improves the quality of estimates and expenses. The first three questions in this section ask about expenses for seeds, fertilizers, and chemicals purchased during the reference year for the operation, regardless of when input is used. Operations often pre-purchase items such as seed, fertilizer, and fuel during the fall for use during the following year. Please write notes if an operator reports unusually high expenses for this year's items that would not be used until next year. At the same time, if any of the inputs for this year were purchased the prior year, they should not be included as part of the current reference year's expenditures. Keep in mind that just because an operator purchased these inputs doesn't mean they were all necessarily used. After all, an operation may have purchased these items intending to grow a certain number of acres of crops that may never have gotten planted for one reason or another. The expense doesn't change, but the operator may then record the unused items as part of the end-of-year assets. On the other hand, if the operator reports unusually low expenses for these items this year, ask if any of these items were purchased the prior year, and be certain that the value is recorded as a beginning-of-year asset. Questions 4 through 8 address expenses that are unique to operations with livestock and should be present if there are livestock inventories reported in Section C. For example, if the operator owns and raises hogs, you might expect to see responses to question 4A or 4B, question 6, or question 8. Other expenses may also apply. When recording livestock purchases in item 4, be sure to include the price of the animals, yardage, insurance, and other fees. In question 9, we're asking the operator to break down all fuel purchases by different fuel types. Farm record books and the IRS Schedule F will usually have an entry for total gasoline, fuel, and oil, but will not follow this breakdown. If the operators cannot break down the individual fuels by dollar amount, try to have them break it down by percent. Any fuel purchased for personal vehicles should be excluded. It should only be reported for what was used on the farming operation. Finally, double check that the total amount spent on fuels on the top line with item code 663 is the sum of all the different fuel types below. This has been a very common recording error over the last several years.
Glad you could join us again. Let's take a look at part of the expense section. Farmer Casey's records show a total fuel cost, but it isn't broken out by fuel type. What is your next step? Is it A, make a note of that and move on, B, probe for a percentage breakdown, or C, use their completed IRS Schedule F? Feel free to pause the video until you come up with an answer. This one might be a little tricky. Unfortunately, the IRS Schedule F typically doesn't follow the breakdown we see on the questionnaire, so that won't be helpful here. Notes are, of course, highly encouraged, but in this case, probing for a percentage, even if approximate, would be the next step to take. So thus the answer is B, probe for a percentage breakdown.
The next several questions are tied to other operating expenses of the farm or ranch, including electricity and other utilities for the farm business, purchased water for irrigation, insurance for the farm business, including crop insurance, interest and fees paid on debts, property taxes paid on real estate, livestock, machinery, or other farm production items, equipment rental, storage rental, vehicle registration, and depreciation expenses. A few items that have been misreported in the past are associated with items 13 through 15, which ask about farm supplies, repairs, and maintenance of farm buildings. The questionnaire provides a brief description of these items, and the interviewer's manual provides a more extended description. For each instance, we want the farm share of the expenses, but sometimes it's difficult to separate the farm share versus the household share. Another question where the line can be blurred between farm expenses and household expense has to do with repairs to the operator's dwelling, recorded in question 16. As a general rule, if the operator's home is owned or can otherwise be declared as an asset of the farming operation, then any repairs to the home can be reported here. Questions 24 through 27 ask about expenses associated with wages, payroll taxes, and benefits for hired labor for the farm or ranch. Please note that questions 25 ask for a breakdown of total wages reported in question 24, similar to the way fuels are broken down by type in question 9. Paid labor includes only those workers whose pay was considered a business expense of the farm during the year. These workers should have gotten a W-2 or a 1099, but they may not have. The table above question 24 has some detailed instructions as to what to include and exclude regarding cash wages. In short, if wages were paid, they should be included here. However, there are some important exclusions. For example, wages paid for workers at a roadside stand or farm store should be excluded, unless more than 50% of what was sold there was produced on farm. You also want to exclude work provided by services forms, such as commercial bookkeeping, legal, or professional services. Those can be included in question 32. Also, if the operator or partners are taking draws from the operation for personal expenses rather than collecting a wage, that is accounted for by a W-2 or 1099. Those should be excluded. Several more operating expense questions follow, including expenses for contract labor, custom work, non-cash payments for farm work, which follows directly from the hired labor questions immediately before them. Also asked are questions about the market value of commodities produced and used on the operation for home consumption, professional and farm management services, and general business expenses. One item historically overlooked and underreported are marketing and storage expenses in question 34. Almost all operations that sell commodities have marketing expenses. All marketing expenses paid by the operator for the sale of all products must be included. Checkoff fees, commercial crop drying, sales commission fees, inspection fees, storage fees and expenses, transportation, yardage fees should be included even if the crop is not yet sold. If a commodity was not sold from storage but returned to the operation, out-of-pocket expenses for storage should be included as a marketing expense. If an operator reports no marketing charges, probe to find out if anything was subtracted out of the total price before the farmer received a check for the sold goods. In many states, certain checkoff fees are standard for all operators. If you can get a total quantity and units sold of a particular quantity, statisticians in your regional field office may be able to derive an estimate for marketing charges. There are a handful of operating expenses that are collected elsewhere on the questionnaire. The first and most notable item includes the component of gross rent, including cash rent, share rent, or grazing fees reported in Section A. Although this was discussed in an earlier presentation, it is important to note the difference in collection of rent expenses from previous years. It used to be that the landlord's share was a column in the field crop production and separate cells in all other types of commodities. Now that the question is collapsed into one cell for every type of share rent, it's important to obtain a full accounting of the landlord's share, especially for crops. As I said before, respondents tend to underreport amounts when items are reported in a single cell versus having it broken out over several cells. The other notable operating expense not included in section includes the livestock contract production fees accounted for in section D and E. Livestock contract production fees are both income to the operator and an expense to the contractor. The second part of section looks at capital expenditures. Certain assets which give a long-term benefit to the farm, such as equipment and buildings, can be depreciated over the useful life of the asset, which is generally 2 or more years. Purchasing these assets is considered a capital expense, in contrast to operating expenses, which offer a shorter term benefit and are therefore written off immediately. Examples of capital expenses may include the purchase of a new tractor or equipment or major repairs to buildings. If an operator places an expense on a depreciation schedule, it should be recorded as a capital expense and accounted for as an asset of the farm or ranch business. One exception I want to note is that land purchases for expanding the operation are going to be considered capital expenses for the purpose of this survey, even though land is not considered a depreciable asset. The first few questions focus on what could be called capital improvements. These are expenses taken on by the operation with the goal of adding value to the farm assets and business. These could include improvements to the land, such as irrigation improvements, well drilling, or fences, new construction and remodeling of dwellings and buildings, including livestock buildings and storage facilities, and new construction or remodeling of the producer's dwelling if it is owned by the operation. As a reminder, any new construction or remodeling of the producer's dwelling should be excluded if the dwelling is not listed as an asset of the farm or ranch operation. The next several questions focus on vehicles, machinery, and equipment purchased for the operation. It is important that the operator be able to distinguish assets used in other business and operator's household. For example, with automobiles and trucks, a specific question is asked about the percent used on the farm. It might be reasonable to expect that a car might only have 40% farm or ranch use and a truck only 80% farm or ranch use. If the farm or ranch use for either of these items is 0%, then it should be included as a household expense. Similarly, if operator runs a separate custom work business, such as for spraying, harvesting, or hauling, then the amount of purchase that would be reported for the tractor or self-propelled equipment or other farm machinery needs to be prorated between the farming operation and the custom work business. Questions 46 and 47 serve as a catch-all questions to account for other expenses that weren't itemized previously in the section. While question 46 focuses on previously unlisted capital expenditures placed on a depreciation schedule, question 47 focuses on production expenses that might not have been accounted for elsewhere in section. Be sure to specify what the expense was for and add comments regarding large expenses, especially if you're not sure if it should be counted as a production expense or capital expense. It's possible that upon further review, we might be able to account for those expenses earlier in section under a different question. However, for some items like potting soil used by nursery and greenhouse operations, these questions might be the only place in section that we can record that expense. The last 6 questions focus on expenses that might be paid by landlords as part of rental agreement. If the primary producer is not renting any land, then these questions can be skipped. Some landlord expenses may be difficult for the operator to know, but approximations or even just knowing that the landlord paid certain expenses would be helpful to know. All landlords should have property tax expenses. If the property taxes are paid by the producer as part of the rental agreement, please write a note to explain the situation. It is possible that the target is renting land to others, which by definition makes the target a landlord. However, we do not want to include any expenses made by the targets in their capacity as landlords on land rented to others. We only want to record expenses that would be paid by the operations landlord and land that was rented from others. I'd like to take a few minutes to look at some of the data relationships you should expect to see in this section. Once you learn what the farm or ranch's main commodities are in the early sections of the questionnaire, you'll want to make sure that particular expenses you would expect to see for that type of farm are accounted for. For example, crop farms are typically going to have expenses for seed, fertilizer, chemicals, and fuel each year. Labor expenses may depend upon the size and structure of the operation, and rent expenses will be dependent upon whether parts of the operation are rented from others. Livestock operations would be expected to have expenses shown here, although the amounts could differ depending upon the structure of the operation. For example, if an operation produces its own feed, then feed expenses could be low. If an operation already has breeding stock, such as a commercial dairy or a farrow to finish hog operation, the amount of livestock purchased may not be significant. Note should be recorded when these expenses are unexpectedly low. Shown here are several expenses that are common to all farms and ranches, be they crop or livestock producers. Even operations where all cropland is idle or signed up for conservation programs like CRP will have property tax expenses at a minimum and may have a few other of these expenses. The expense information report is considered the most important information to be collected on the questionnaire. National, regional, and state level estimates published in the annual Farm Production Expenditures report come directly from this information and are broken down by farm type and sales class. Because of the variability and uniqueness in every farm situation, incomplete information in this section cannot be easily estimated. Because of this, if an operator does not provide any information in section, then the entire report might as well be considered a refusal. As you are collecting the data and as you are checking your work, you'll want to see how the expenses reported in section compared to items reported in other sections of the questionnaire. Here are a few examples of data relationships to check across sections. If debt was reported, then there should be interest expenses in item 19. Now, it is possible for a farm to have no end-of-year debt and yet incur interest expenses if all the loans are production loans. The debt table should identify any production loans taken out and repaid during the year. If paid labor hours were reported, then there should be cash wage expenses reported in questions 24 and 25. The breakout of the labor expenses should closely follow the hours reported for the target operator, the target spouse, other members of the household, and other paid workers. Be mindful, however, if the operator, spouse, and partners are not paying themselves a wage, but are rather taking draws from the business in order to pay for household expenses, then wages should not be reported in section, and all work hours should be considered unpaid. If any land is owned or rented in section A, someone should be paying the real estate taxes on that land, be it the operator or the landlord. If no one is paying the tax on the land, then include a note to explain the situation. Dairy operations should all have hauling expenses reported in item 29A. If these expenses were netted out of the operator's milk check, add them back to get the net figure. Also, all vehicles owned or leased by the operation should have registration and licensing fees reported in item 22. When working with the operators to complete section, encourage the use of farm records. Farm records help to provide more accurate data and shorter interview times. If it is available, the Schedule F tax form will contain some information that could help you in completing section, but it will be in summary format and you will have to split it out for ARMS 3. Shown on this slide, you will see the items that would be recorded on the Schedule F and the corresponding questions on the ARMS 3 form. Let's summarize briefly what we have learned here. All farms and ranches have expenses. On this survey, we are separating those expenses between operating expenses and capital expenses. Operating expenses are those incurred through normal day-to-day business operations, while capital expenditures include expenses that the business incurs to create a benefit in the future. Operating expenses are generally written off from a farmer's net income in the year because those items or services are consumed within a year. Capital expenses, on the other hand, are made on long-term assets and are generally written off over time by deducting a depreciation expense each year until the asset depreciates to nothing. Although there's a lot of these sections, try not to get bogged down in the details. Do your best to find the best fit for each expense item and record it there. When you're done, ask yourself if the questionnaire makes sense and leave comments when in doubt, or if you see any unusual situations. Be careful not to double count expenses in multiple places. By encouraging the use of farm records, accurate information will be readily available and answering the questions will take less interview time. If you have any questions, please be sure to refer to your interviewer's manual, your supervisor, your NASDA coordinator, or the statistician in charge of the ARMS 3 survey in your regions. Thanks for watching.